Problem 13-2B, page 633 in your textbook. Stock transactions for corporate expansion. Pulsar Optics produces medical lasers for use in hospitals. The accounts and their balances appear in the ledger of Pulsar Optics on April 30th of the current year as follows. We have our preferred 1% stock, $120 par, 300,000 shares authorized, 36,000 shares issued, 4,320,000. Paid in capital in excess of par on preferred stock, $180,000. Common stock, $15 par, 2 million shares authorized, 1,400,000 shares issued, $21 million. Paid in capital in excess of par common stock, $3,500,000. Retained earnings balance, $78 million. At the annual stockholders meeting on August 5th, the Board of Directors presented a plan for modernizing and expanding plant operations at a cost of approximately $9 million. The plan provided A, that the corporation borrow $1.5 million, B, that 20,000 shares of the unissued preferred stock be issued through an underwriter, C, that a building valued at $4,150,000 and the land on which it is located, valued at $800,000, be acquired in accordance with preliminary negotiations by the issuance of 300 shares of common stock. The plan was approved by stockholders and accomplished by the following transactions. We have October 9, 17, and 28. Our instructions are to journalize the entries to record the October transactions. On October 9th, we borrowed $1.5 million from St. Peter City Bank, giving a 4% mortgage note. If we borrowed the money, that would mean that we were receiving cash and that we were signing a mortgage note payable. So we would debit cash, credit mortgage note payable for the $1.5 million. On October 17th, issued 20,000 shares of preferred stock, receiving $126 per share in cash. The accounts that will be affected by this transaction are cash, which we are receiving for issuing the preferred stock. We will be crediting preferred stock for the number of shares times the par value, and if anything over that, which we will have, goes into paid in capital in excess of par on preferred stock, which would be for $6 per share. So our entry would be a debit to cash for $2,520,000, which would be the 20,000 shares times $126 per share. Preferred stock will be credited for $2,400,000, which is 20,000 shares of preferred stock times $120 par, and then the difference between the $2.4 million and the $2.52 million received in cash goes into paid in capital in excess of par preferred stock for $120,000. On October 28th, we issued 300 shares of common stock in exchange for land and a building according to the plan. Because they do not give us the market price of the common stock, we must use the fair market value of the assets acquired to make this transaction. What we are receiving is a building valued at $4,150,000 and land with a value of $800,000. And we are exchanging 300,000 shares of common stock in exchange for that building and land. The accounts that would be debited would be building and land, and a credit to common stock, and a credit to paid in capital in excess of par on common stock if the value of the land in comparison to the number of shares of stock is more than the par value. Building would be debited for $4,150,000. Land would be debited for $800,000. A credit to common stock for $4,500,000, which would be the 300,000 shares issued for this transaction times the par value of $15 per share, and then the excess of that amount of $450,000 would go into a credit to paid in capital in excess of par on common stock. So we have the $4,150,000 plus $800,000 means that our total debits adds up to $4,950,000. $4.5 million subtracted from that leaves us with the $450,000 amount going into the paid in capital in excess of par common stock. And that is the end of problem 13-2B.